Okay, we seem to have a good number of people now, so I think I'd like to start by saying hello and welcome to the Impact Investing Institute's webinar on the realities of impact investing in 2021. We are very excited to have two great speakers with us this morning and an interesting conversation ahead. Now, I would like to invite our speakers, Dame Elizabeth Cawley and Sir Ronnie Cohen, to turn on their videos. As a short introduction, Dame Elizabeth Cawley was formerly the CEO of Allianz Global Investors and is the chair of the Impact Investing Institute, a director of the Green Finance Institute, and is a member of the CFA Future of Finance Advisory Council, AQR Asset Management Institute, and on the committee of the 200 and the 300 Club. Sir Ronald Cohen is recognised as the father of impact investment and European venture capital. He serves as the chairman of the Global Steering Group for Impact Investment, the Impact Weighted Accounts Initiative at Harvard Business School, and the Portland Trust. He is also the author of the book Impact: Reshaping Capitalism to Drive Real Change, which was published in 2020 by Penguin Random House. So thank you so much for both of you for joining us today. We are very much looking forward to the conversation, and I will hand over to you, Elizabeth.
Hi, good morning and good afternoon, I see. I mean, fantastic. I've been smiling here looking at all the welcomes from everybody and the mornings. So hello, everybody, Singapore, Dubai, Switzerland, Denmark, Munich, where I used to live. Well done, Laurie, for saying London. So fantastic to see such a broad and international range of friends and colleagues joining us this morning. Oh, and Israel too. Sorry, I won't be able to keep up. Vancouver. Oh my gosh, Vancouver. All I can say is thank you. I think kudos to you so far for being with us today. I'm not going to spend too much time on introductions because Lizzie's done a great job introducing Sir Ronnie and me. As you know, I'm Elizabeth, he's Ronnie. We don't use our titles. They're there for, frankly, for work of everybody else that has done to support us. We're really, really looking forward to our conversation. Ronnie knows I've had tremendous admiration from him from the beginning. I partly blame Ronnie for the fact that I'm where I am now in chairing the Institute, because without his extraordinary pioneering work, real visionary leadership, we wouldn't have an Impact Investing Institute in the shape and form it is today. We'd have something, but his mark is still with us. And clearly his work around the world as chair of the Global Steering Group, making sure that we have equivalent organizations in, I think, 34 countries now, Ronnie, is remarkable. Now, we want to set expectations for this meeting, okay? And it's very simple. If we take the subtext of Ronnie's book, it is reshaping capitalism to drive real change. So that's what the conversation is going to be about. And with no further ado, Ronnie, let's turn over to you. I know you want to make some opening framing remarks, and then we'll go into a conversation together.
Well, Elizabeth, first, let me say how great a pleasure it is for me to be in conversation with you, with all our colleagues across the world from the impact space, and well done to the Impact Investing Institute for all the work that it is doing, for hosting this webinar. And well done to you for the leadership that you have shown in the field with your task force, with the Institute, and with all the other initiatives that Stephanie mentioned, or Lizzie mentioned. So let me start off by saying that I have the sense, Elizabeth, that we are at a very exciting juncture in terms of humanity. We've seen a change in values, which started with consumers and then went to the talent employed by companies, where consumers and talent refuse to purchase the product or to work for companies that do harm, environmentally or socially. This didn't escape the notice of investors. They realized that this had very deep implications for the performance of their portfolios, but at the same time, they were under pressure from their clients too, as you well know, coming from the investment sector. And even savers through pension funds began to put pressure on their managers to adjust their portfolios. And this has led to, in terms of humanity, to a massive leap forward where investment which seeks to achieve more than just profit, what we call ESG and impact investment, together today amount to 30 or 40 trillion dollars, about half of all professionally managed assets in the world. This very powerful trend meets two other powerful trends. The second one is huge leaps in technology, which amplify our ability to deliver impact globally in ways that humanity could never contemplate previously. Artificial intelligence, machine learning, augmented reality, all the other technological leaps which converging technologies are enabling us to make, those give us a major opportunity to improve lives and the planet. And finally, this technology has enabled us to make another massive leap, and that is in the measurement of the impact of individual companies. Actually measuring and monetizing the product impact, the operational impact, and the employment impact of companies. So these things have come together to set in train a revolution which, in my view, is going to be as widespread and as deep in its implications as the tech revolution was. The impact revolution has already started to disrupt a number of sectors. We see it most clearly in the automobile sector, Elizabeth, where a company like Tesla, which entered the sector not because the automobile industry was very welcoming of new competitors, but because it wanted to shift it away from the combustion engine to create positive impact, more positive impact on the environment. And this has led to Tesla being worth several times the value of any of its competitors. In fact, it's worth today the value of 5 of its competitors put together. So that's why I say in my book, Impact, that we are actually witnessing a shift of our economic paradigm from risk return to risk return and impact. And it's the only way, actually, that we can cope with the great societal and environmental challenges we face.
I mean, you're absolutely right. And it isn't, we've lived through an extraordinary period, and we have this coincidence of the dreadful pandemic, an acknowledgement at last of the urgency of the need to address climate change, and the fractures shown in our society by the Black Lives Matter movement and the social justices movement, and the inequality of the way in which COVID is affecting societies. I suppose the obvious question that comes to you and to me all the time is, are the markets, our capital markets, going to drive change fast enough? I mean, you've just described the fact that we're at a pivotal point in a revolution, but it doesn't feel like a revolution at the moment. It feels like rapid change, but are we moving fast enough? And how do we know that we stay the course? Because it will get difficult.
So markets have started to play their role, and ESG and impact investing are growing at 15 to 20% a year. They will continue to play their role. But unless governments step in now, Elizabeth, and play an enabling role, as they did in the 30s, after the Great Crash. I mean, there is a very interesting historical parallel, because after the Great Crash of 1929, 4 years afterwards, the US government brought in generally accepted accounting principles for financial reporting and of course, the use of auditors. Many of us may not be aware that up until that legislation, every company could pick its own accounting principles and there were no auditors to verify the numbers. And that there were remonstrations in Congress at the time that this would be impossible to do, to have a single set of accounting principles for every company, irrespective of its size or its sector, seemed absolutely impossible. And yet today, all of us know that this has laid the foundation for the massive investment in financial markets that we have been able to build. And I think the historical parallel, Elizabeth, is with transparency on impact today. Investors need the information that's necessary to make the right decisions when they seek impact as well as profit. And one of the cries that you hear from the investment community, as you know, the GSG hosted a meeting yesterday with about 15 different leading investment organizations. Everyone was asking for standardization of impact measurement, because if you don't have that, then it's impossible to make the right decisions. And we're even seeing the regulators today, IOSCO, as you know, which brings together the world's regulators, have got involved in looking at how they can provide to investors consistent, comparable information about companies. So you're quite right. For this revolution to happen, government needs to play a role. Markets can't impose on companies uniform reporting standards, uniform forms of financial accounting. And actually, I think we're going to get to it a little bit later in our conversation, but actually governments need it today. They can't face the aftermath of COVID effectively without it.
I mean, it's interesting, isn't it? You reference the historic nature of what we're talking about, and I think you're absolutely right. But it took, I think, around 50 years to move from generally accepted accounting principles, so-called GAAP, to something that led to an international accounting standards board. And we don't have 50 years, do we? We just absolutely know that if we do that, we're going to miss all our targets, at least on climate change, and the social inequity will continue. What should we do to accelerate? You say this is a year of COP26. It's a year where global leaders are hugely sensitized to the need to build back in a more resilient, fairer, and more equitable way. But I think governments could say, well, we've spent a fortune. With the reaction to the pandemic has been a magnitude greater than to the financial crisis and other crises we've had in the past, a magnitude bigger. And so I think they're going to say, well, it's down to you, private sector. It's down to you, companies. And what should be our conversation with companies, do you think, right now, who, if you think about it, are struggling with massive uncertainty, disruption, economic outlook that is very, very vague for some sectors? What can we reasonably ask of the leadership in business right now? Reasonably ask, given that many of them won't have the capacity to do everything we would like them to do.
Well, that's a crucial number of questions that you've asked, Elizabeth. I think the first thing is we have to make governments aware that they don't have the resources because of the huge indebtedness they have today to meet the increased social challenges they're going to face because of higher unemployment. You're going to see greater homelessness. Poverty is going to create a whole slew of issues in its wake. And unless governments are able to bring private sector capital and enterprise alongside them to achieve government priorities like restoring employment, helping the most vulnerable through the crisis, having capital flow to the organizations that can really help to achieve that, businesses and non-profits alike, the recovery from COVID will be a lot longer and a lot less effective. Second point that you make is crises create two different forces. They create a first force, which is a desire to focus simply on getting back to normal. But they also create a second force, which is, this has been happening over and over again. We have to emerge from this in better shape than previous. And actually, Elizabeth, you and I both lived through the 2008 crisis. We both know that we didn't really react to that crisis in ways that improved our system virtually at all. And here we are, just a dozen years later with a massive crisis, which creates pressures that are similar to those we knew in the 30s. And I think COVID has created a receptiveness now for bold steps. And the interesting factor is that the help governments have had to give companies give governments the right to require companies to do certain things in return that make government's tasks easier, that improve society and the environment, that don't create massive societal and environmental problems that governments have to tax everyone in order to deal with. So I actually think there is an opportunity for a bold step forward. And then the last point, when people say, well, you're going to be heaping an additional burden on companies at a time when we need them to concentrate on just creating jobs. Let me just give you a peek into the situation we are living in. The effort at Harvard Business School, which Lizzie mentioned, the Impact Weighted Accounts Initiative, which is a joint initiative created by the GSG and the Impact Management Project with George Serafim and Harvard Business School, has published the environmental impact of 1,800 companies and monetized them. Now, this gives us a peep into the future. What if I told you, Elizabeth, that 250 of these 1,800 public companies across the world actually create more environmental damage a year than they make in profit? That a third of them, 600 or so, create environmental damage equivalent to a quarter or more of their profit. And that taken together, they create about $3 trillion of damage in a single year. If I told you that Associated British Foods, a highly respected British company, makes $1.6 billion of profit a year and creates environmental damage of $1.8 billion. If we have this sort of information about the environmental damage, but also about the employment impact of companies, the positive impacts that companies create. You take a company like Apple, again, a peep into the future. Apple spends about 10 billion a year on its 60,000 employees in the US. You would expect that to be all positive impact because it's employment. But if you begin to compare, as the Harvard effort has done, the demographics within Apple with the demographics outside its facilities, Elizabeth, and you begin to ascribe remuneration levels of the different echelons of Apple for the missing representatives of communities, whether they be minority communities or gender-based or whatever. And if you look at differences in the advancement of people from these communities, differences in gender pay, there's a $2.7 billion negative charge to Apple's $10 billion of positive impact. Now you can compare that with Costco, which employs twice as many people and has $1 billion charge. So clearly more diverse and treats its employees more fairly. That's the peep into the future. And if you add to that the product impact, which we are also measuring, and we will be publishing 3,000 or so companies' employment impact and several hundred companies' product impacts across 11 sectors over the next very few months, you begin to get a peep into what the investment world is going to look like. But it's not just the investment world, it's everyone on this webinar that wants this information. It's us as consumers, it's us as pension savers, it's us as employees of companies. And when we talk about companies not being receptive to this thinking, I think we have to bear in mind that the employees of these companies very often are very receptive. and that the cultural change that's required for management to aim at new goalposts, which are profit on one side and impact on the other, that cultural change is not going to be as big and as challenging in many companies as we assume it's going to be.
I think you're right. I mean, you know, from the engagements that you and I both have, we know there are many companies who are very, very keen to try and rebalance towards what you know is now called multi-stakeholder capitalism, to move away from a sort of the tyranny of a quarterly dividend or whatever, or half-yearly dividend. So I think that you're right, but the challenge is that capital markets still, as you say, are they're very data-driven, and the pressures are in the future as opposed to in the present. And there's an interesting question come through about, is it really only investor engagement that will drive change? And that links to another question that's been voted up, which is around how can we make sure that this becomes an intrinsic desire to change as opposed to an extrinsic force? And I think those are two very powerful questions. What are your thoughts on that?
So I think, Elizabeth, it has to come from everywhere. If you're going to have such a major change in our economic system, but one which is already underway, because the Harvard data already shows that this impact information is price sensitive, in the sense that the companies that pollute more within certain sectors are worth less than their competitors, right? So the information that is flowing already, insufficient and inconsistent and incomparable though it is already tilting the scales in terms of the valuations of companies. So this makes it extremely relevant today to corporate leaders who have been used to and often are remunerated according to the performance of their share, right. As you know.
Yeah. But sorry, I just want to interrupt because I can see questions coming into the chat, and can I please ask you to repost the questions into Q&A, because then they can be voted up and we can all see them in one place. So if you've put a really good question into chat, please could you pop it back into Q&A? Sorry to interrupt, Ronnie, but I can see some good points coming up, but they're coming up sort of slightly off field. Thank
Wonderful.
you.
I look forward to answering all the questions that are coming in.
There's quite a few, so yes. But it's interesting. I mean, you talk about the link between performance and pay, and I know just looking at the UK, ESG factors now feature increasingly in executive director pay. So we can see that incentive is being aligned as well, which is fantastic. But a lot of what we're talking about will sound quite sort of macro level to people who want to see direct impact now on, improving the situation for the planet, improving the situation for people. And I think we should probably spend a bit of time talking about impact investing, which is absolutely directing capital for measured intentional outcomes, because this is a complement to the sort of the wider change in capital markets. You've been a pioneer here. You've seen extraordinary change and development. What do you think are the most exciting developments in impact investing? And difficult question, but are you concerned about anything that's happening in impact investing? So the positive and then any challenges.
Thank you. So Elizabeth, let me just complete the answer to the question about are investors alone going to be the big lever for achieving this? The answer is no. I think consumers have a major role to play. I think talent within companies has a major role to play. I think philanthropists have a major role to play. The whole neoliberalist movement was funded by philanthropists who got it, going. And I think governments have a role to play, and of course, corporate leaders. So we have to bring all of these different stakeholder groups to push for action. Now, can we get immediate action? The answer is yes, we can get immediate action. We can get immediate action in the form of a carbon tax, for instance, while we achieve transparency, which brings us to a fairer tax system where companies actually get taxed for the damage they individually create instead of taxing everyone for the damage created by some. So that's, the answer. So each of us should view themselves as activists in each one of these, relevant roles. Now, to the question about impact investment. Impact investment was the place where risk-return impact was first optimized. The social impact bond, which was developed in the UK, and I was privileged to play a role in, was the first security the world had seen, to my knowledge, where the return depended on immeasurable social improvement. And this concept of risk-return impact is beginning to get translated into investment strategies that lead to greater creation of value rather than less. So in the early days, as you know, Elizabeth, there was this shibboleth that somehow, whenever you invest with impact in mind, you're going to make less money. What's going to drive this forward is that we're beginning to realize that actually, because of the changed values, because of the technological leaps and the measurement of impact, the world has changed. And the best way, actually, to deliver greater growth and profits is by optimizing risk-return impact. Now, what keeps me up at night? What keeps me up at night is greenwashing, because we can see with ESG ETFs doubling and trebling in 2020 alone, with the price of Tesla stock multiplying by 7 times in 2020. We can see there's huge momentum in the market now in favor of investments that bring some impact. But if you don't bring measurement to ESG to turn it into impact investment, because the definition of impact investment is intention plus measurement of impact. If we don't turn the 30 to 40 trillion of ESG into impact investment, then we're not going to be able to achieve the real impact that we potentially can. So for instance, with the SDGs, the only way to plug the $30 trillion hole of missing money to achieve the SDGs in this decade is through private markets.
I totally agree. And it's interesting, I noted in, I think it was last week, that in Germany, there is the Consumer Protection Agency there is taking one of the asset managers in Germany to court, or trying to take them to court, alleging that they've miscategorized and misdisclosed around their impact fund. So it'll be interesting to see that. And we know you mentioned IOSCO earlier in terms of global standards, but one of the other themes that IOSCO is looking at is precisely greenwashing. I'm often asked, and I'm now asking another expert, how do people know what a good product looks like though? If people want to start using the power of their own purse or wallet, how do they know what good looks like when they may not be confident enough to move into impact fully, but do want to move into ESG? What are your thoughts on that?
So my thoughts are that within the next 2 or 3 years, we're going to have apps on our telephones that enable us to scan the barcode of a box of Twinings tea, which Associated British Foods brings to our supermarket shelves, and see what the environmental impact, the social impact of bringing that product to our shelves is, and also of Associated British Foods itself. But at the moment, we lack the standardization of measures so that these figures really are comparable. But I think it's already beginning to, as we were saying earlier, to affect our purchasing decisions. But we need information to be able to do it. And I believe technology will supply it as long as we can provide the impact information.
No, I'm very supportive of that. There's a good question come in that's being upvoted around the fact that in your book, you can compare and contrast Coca-Cola and Pepsi. And the question is, do you think that the loser in that comparison will be disappointed? Are they even aware of that there is a differential? And I wonder if their consumers are aware, to build on your last point.
I think, I haven't analyzed the stock price changes. I doubt that this information is widely enough known. The book has sold several thousands of copies, but it needs to sell a lot more. All of its royalties, by the way, are going to impact charities. So do spread the word about it. But I think their employees are going to be very concerned by it. And I think Coca-Cola will understand that there is the risk of regulation for its water usage or of taxation because of its water usage. And that some investors are going to take that into account in valuing the company. And it's not going to be a positive for Coca-Cola.
Yeah, it's going to be an interesting case study to watch, because we can all put those two stock prices into our phones and just see how they evolve in the next year. So I think it's a great example to have called out in your book, because it's also a consumer example that's closer to the individual choices people can make than some of the major sort of oil or other stocks. There's a good question come through around the role of rating agencies and the role of labeling. And let's just deal with rating agencies and credit, because we've talked a lot about stock price, and obviously public equities is a critical way of looking at the way in which these influences are being valued on a company. But the realities are that most funding these days is debt. And so that gets us into the whole question of credit rating. Now, we've seen a huge amount of sustainable bond issuance, including some use of proceeds bonds that are getting into the social area, which is fantastic. But what do you think needs to happen to really, number one, accelerate responsible debt markets, and then link to that the role of the credit rating agencies within it?
So let's start with the credit agencies. In our work at Harvard, once we had the figures for these 1,800 companies' environmental impacts, we compared it to the ratings that had been provided for these companies, and there's virtually no correlation. The reason is that the rating agencies have focused on process. Do you have the governance in place, etc., rather than on the outcomes achieved. But the rating agencies are going to be the first to use this information, which is open source and available for all of them. So we can expect big improvements in rating. Now, to come to the question of credit, which is a massive lever here, 50 banks have already announced that they're going to be taking into account the environmental footprints of the companies they lend to. So this is already coming. Leaders like Brian Moynihan of Bank of America, Bill Winters of Standard Chartered, and many others have already begun to talk about the role of sustainability in making lending decisions, because these negative impacts have implications, as they do for equity investors, for lenders as well, for the viability of a company. If you were going to be lending to a coal mining company and you didn't take into account the possibility of regulation and taxation today, you'd be making a very big mistake. So I think you find inspired banking leaders, just as you find inspiring investment firm leaders and inspiring corporate leaders. The leader of CaixaBank in Spain is an example of a person who totally believes that we need to get to impact transparency. And so the difficulty we're going to have, Elizabeth, is that exposing the negative impacts is going to be uncomfortable for companies. And so we need to marry it with transition plans. If a company says, well, okay, we haven't been measuring impact, but now we're measuring it, we see our positive employment impact, we see our negative environmental impact, we see the positive and negative environmental impacts in our products. And we're going to have a transition plan to eliminate the negatives and boost the positives. And then investors will continue to engage with them, because investors can't just invest in the companies that are doing good. And then, because there aren't enough of them. And the companies which refuse to do that, as ExxonMobil, has been an example of a company, it seems to be changing a bit now, but until extremely recently, was saying we don't believe that we need to go into clean energy. We are going to double down on fossil fuels. And of course, their share price has dropped by 2/3 in 3 years. And so I think we have to marry this concept of transition plans for companies with the greater transparency, so that the enlightened corporate leaders have a path that enables them to bring their investors and their talent on side in achieving these ambitious objectives.
I totally agree with that. And I think, that there's this concept in the investment world of a universal owner. Just because somebody deselects a particular company or issue of debt from their portfolio, somebody else owns it. And if we demonize sectors or demonize companies, there is then no external drive for change through the capital markets, because they will end up in the sort of ownership that doesn't care. So I think you're totally right. And I think what in this year of COP26, we can see a lot of focus on transition plans, TCFD as a means of asking companies to disclose in a consistent framework. I don't want to get into a sort of environmental topic, but I want to use this as an example for the challenge, even when we've got something as well established as TCFD. The US and UK have fundamentally different approaches to putting a price on carbon, fundamentally different. So even when you have a global agreement that we need to reduce carbon emissions, or CO2 emissions, we need to disclose it. We have two quite different standards, which are going to end up with different carbon prices. What do we do to bring that together and to encourage a greater collaboration globally around such things as this? And I'm using that because it's the obvious one. There are other areas where we have differences.
Yeah, I think we have to get to standardized impact accounting principles, GATE, if you like.
Yeah.
Generally accepted impact principles, preferably global ones. We have a schism today between the US and the rest of the world. IFRS F, which is responsible for accounting across the world, is looking, as you know, at setting up a sustainability accounting standards board. FASB in the US hasn't begun to do so. There are some differences in approach, but I believe there's an opportunity now to create a joint effort at the impact level. And then we will have to do as we did with financial accounting, get the profession to sit around the table and to work out what gives the best objective measure of the impact. The aim isn't to provide incentives through impact accounting. Governments can do that through incentives, taxation, accelerated depreciation, and so on. The aim is to give an objective view of it. Now, what's happening today is some people are looking at the carbon offset prices. So the carbon credit market has a price between $5 and $30. Some people are looking at scientific evidence that says it's actually $300 per ton of carbon emission of damage that is caused. Some people are saying, well, if you discount it at 3%, there's a big argument about whether you should. Here, it comes down to $120. We need to sit around the table, and we need, as we did with financial accounting principles, which, by the way, are still being changed on a monthly basis. So this is a living framework. We need to make a good start. Pick figures that make sense from a scientific point of view, and then improve.
It's interesting. I mean, what you're saying resonates with a couple of the questions that are coming through now in the Q&A around the fact that disclosures, even if they're standardized, aren't going to tell you the whole truth, and that there's a need for, it's more of a statement than a question, there's a need for real engagement from the investor community. And in order to get under the bonnet, if you like, and look what's really going on in terms of the outcomes that are being reported. I mean, that's something in your book you pick up very strongly.
Yeah, and you and I have chatted about this before, Elizabeth.
Yeah.
Sometimes we expect more out of the new impact accounting system than we do out of the existing financial.
Exactly. Yes.
We've chatted before about this. I mean, there are still big debates about the recognition of revenues for software companies versus other companies. For example, when do you book as a sale a multi-year contract that has been signed? And so it's taken us 9 decades to perfect the financial accounting system. It should take us a lot less than that to perfect the impact accounting system, given the technology at our disposal now. But it's going to take time. The important thing is to start off well with measures that enable us to make comparisons that are pretty reliable, that are dependably reliable between the impacts of different companies, because that's what's going to change the behavior of companies.
Right. I think amazingly, Ronnie, we're into the last laps of our conversation. So I'm going to just start reading a couple of questions to you that have been upvoted. Many of them we've weaved through in the conversation. But there's one here from Matthew Johnson, which has got it's next in the sort of ranking after the ones we've dealt with. What types of impact investments, for example, themes, sectors, asset classes, would you like to see greater activity, but currently investors are not pursuing?
Well, that's a great question, Matthew. I mean, obviously education is a massive challenge for humanity. There are 800 million children across the world who are either in or out of school and not learning. I would love to see really disruptive technologies come in now to boost our ability to educate. And there are technological improvements. I want to just mention one briefly, Elizabeth, that begin to explain the power of impact thinking. So there's a company here in Israel from where I'm speaking today, which develops spectacles for the blind. I mention it in the book. It's a company called Orcam. There's a little memory stick-like device which whispers in the ear of the wearer the page of the book they're reading on the banknote. There are about 300 million blind and visually impaired people in the world. But if you begin to think in terms of impact, you ask yourself the question, what's the technology capable of doing for the maximum number of people in the world? And then you discover new market opportunities, because the answer to that question in this case is, what if you provided these spectacles to the 800 million illiterate people in the world? What would that do for their lives and livelihoods and so on? So I think technology enables us today to bring impact to every single sector. I think education's a big sector. I think the financial sector is ripe for an impact revolution. Having a banking system where the most vulnerable end up being charged the most because they're perceived as being the highest risk, when today you can measure their credit worthiness through the use of their cell phone, you know, as another company I mentioned in the book does. I think that's another area. Health, obviously, after this pandemic, the delivery of health remotely is going to be a big issue. But every single sector, just as happened with technology, is going to be disrupted by the measurement of impact. So just pick the sector that you're passionate about, define a business model that delivers impact as well as profit at the same time, and go for it. And as I describe in the book, aim to create an impact unicorn, a venture that's not just worth $1 billion, but improves the lives of 1 billion people too.
Yeah, and maybe I could just add a perspective on the Impact Investing Institute to that same question, because I totally support what Ronnie said, and there are some marvelous examples of real life-changing investments, products that have become investments that are really, really successful. The theme we're looking at very strongly in collaboration with the Grantham Research Institute is making the transition to a net zero economy a just transition, a fair and equitable one. So for every green action, there is a social consequence, positive or negative, and the way in which you transition can change people's lives positively or negatively. The obvious way is around thinking through jobs, skills, reskilling. We know we've had stranded assets in the past, but we've also had stranded communities, and thinking through very deeply the way in which this transition to a greener world is a better and fairer world is a big focus for us. So that is very much an investable theme. Whether it's through use of proceeds bonds or looking specifically at listed companies that are taking their transition responsibilities very seriously and doing the right thing in the right way. So that would be one I'd add to Ronnie's very good list. There's a question about superficiality, Ronnie, and what's currently happening now. So we're talking about a brave new world in the future, but is there a risk that all this money that's moving into ESG does nothing to address the SDGs? I think we both agree there is a risk, but how do we now start to make this ESG money more accountable right now?
So we've seen UNDP, which, as you know, created the SDGs, Elizabeth, and now set up the big impact effort and begin to publish impact principles for investors to implement. We have to shift to different sectors, like we've talked before of public and private investment, sectors like venture capital and private equity, which have, you know, such great influence today, a $5 to $7 trillion pool of money, which is powering change, basically. But we have to define methodologies now that are appropriate for, you know, for private equity and venture capital. We're doing the same in property and in infrastructure, albeit you know, they're much smaller sectors. It comes back to measurement. And when people say it's far in the future, I think because of the price sensitivity of impact information, we will have regulation mandated within the next 3 to 5 years. You can't have $40 trillion sloshing around and disparate information, you know, going to different investors. That's not what regulators are, you know, in existence to do. They're there to ensure orderly markets, consistent, complete, quality information. But the point you made about environmental and social is so important, Elizabeth, because environmental has taken off after 4 decades now. But if we only focus on environmental, as you say, we ignore the social consequences and we get what happened with the Gilets jaunes. And so I applaud what the Impact Investing Institute has done to reframe the social by calling a lot of the initiatives Green Plus today, because I think that's a very good way to make people aware of the interrelationship between social and environmental. We have to solve for both. If we try to solve for just one, we will fail because of the consequences on the other.
Well, we passionately agree with each other on that, but you've linked me through to another question from Jess here, which I think is a really, really important one, because we talk about investors in a sort of all-powerful way, but of course they're agents for other people's money. And the question here goes to the root of the ownership and fiduciary responsibility for that money. And Jess has said, how pension funds balance impact and return in the context of fiduciary duty. And she's made, or he or she, sorry, I'm not sure whether Jess, apologies, or they, the new UK DWP consultation in reality is about the effect of climate risk on portfolio, not the portfolio's impact on the environment or social. Now, you and I, again, have discussed this sort of risk mitigation versus real impact before, Ronnie, at length. And I think this is a really, really important point. that to really get a transition, it's not about risk mitigation. Of course, prudential regulators will want to see that happening. But how do we move this forward, not just with regulators, but also with the pension funds themselves?
I think it's by making it apparent through the data that's coming out of Harvard Business School and other places, that the value of companies, not their immediate profits, but the value of companies on stock exchanges is being affected by the impact performance. This makes it important not just to look at things that affect the profitability of the company, but on impact of on the environment and society, which affect their value too. I think it's crucially important now that all of us tie these two things together. I think there's a good chance that IFRSF will come to the conclusion, because of the representations it has had, 600 or so on, that it needs to tackle both, that the materiality of information isn't what's relevant to the firm, it's what's relevant to the investor. If the investor needs information about the impact on the environment, which doesn't affect the profit of the company, to determine the risk of regulation or greater taxation or inability to attract talent in the future, it's what's material to investors that regulators and accounting bodies have to provide.
I think that's very, very well said. I suppose one thing I should say on behalf of the Institute is that we have done work on fiduciary duty. If you go to our website, we've got a pensions hub. You can find resources there. If you happen to be if you're a pension member, you definitely should, but if you're a pension trustee or in the administration or management of pension money, we have the Pensions Hub. We have a paper co-authored by a number of legal firms for us on fiduciary duty, and also some principles to help trustees find their way through this whole question of impact. And they're very simple, 4 principles that can be used, and they're very plain English. So do go and have a look at that, because again, we think we can start to do that now. And I completely agree with Ronnie. The regulators are doing the necessary, but they're not doing the sufficient to drive this revolution forward. Ronnie, we've got more questions than we're going to be able to answer. And I know that Lizzie and Steffi are going to try and work on a digest of these. Somebody's actually just alerted somebody that there's an event coming up on the 24th of March. Please do look in the chat for that. I'm going to ask you, because we've got 5 minutes left, for some closing remarks and maybe a call to action for this wonderful range of participants we've got. I haven't been able to mention all the countries. I would be going around the globe, essentially. It's easy to say where we haven't got representatives from. So your closing remarks, Ronnie.
So I think, Elizabeth, first of all, it's been wonderful to exchange views with you and to answer all the questions from our movement that have come in today. I think the essential message today is that there is something massive that's happening in the world, and we've played a role in informing and in shaping it. We need, however, to ensure that we get to the right destination. There are going to be forces that are going to push back because the status quo favors them today. So companies that are doing harm in particular, socially or environmentally, are going to push back. But there are, as we were saying earlier, inspiring, thoughtful leaders with vision in the corporate community who will show the way forward. The efforts have to be made today to bring the investment community to push for the standardization it needs. Regulators are in place to satisfy the needs of the investment community. So it's logical that the investment community should have the greatest influence in the situation that we have today. We must get to a situation where we have impact accounting. We cannot stop at reporting in non-accounting terms, often qualitative terms, often metrics, on environmental only. It has to be environmental and social reporting and accounting, and hopefully we will get to a single set of impact accounting principles across the whole world. But at the same time, there needs to be a massive popular movement around the fact that transparency really is a new human right. Transparency on the impacts that the companies that employ us or provide products that we use is something we have a right to have. And so our ability as a movement now to persuade our political leaders to bring about this transparency is also massively important. Our purchasing preferences, our employment preferences, our lobbying of our political leaders are crucially important. Now, if we look at the whole picture today, the big missing influence is the influence of pension funds. There's $38 trillion worth of money in pension funds across the world. These pension funds are often very remote from the values of their savers. We've seen certain countries, the UK's one, Holland is another, where savers have actually become much more active now in influencing their managers to take impact into account in their decision making, but they too have to provide this transparency. And it comes then to really the three priorities ahead of us, Elizabeth, the call to action. One, coming out of COVID, we have to make sure that all of the impact capital that we have helped bring into existence and the ESG capital, which we can help turn into impact investment, goes to address the major issues which COVID has created. Issues around employment, issues around education, issues around the most vulnerable being hit, in particular those living in slums or informal settlements, as we call them. The second is transparency, which we've talked about a lot. And the third is the one you've been referring to, which is tweaking the obligations of trustees, of pension funds and of charitable endowments, which are very influential in terms of impact investment, because they share our social and environmental mission, to tweak them so that it is clear that trustees have to take into account, not may take into account, but must take into account social and environmental issues in making their investment decisions. Elizabeth, I lived through a single regulatory change. At the beginning of my career, I started what became Apax when I was 26, as you know, 1972. In 1978, there was a regulatory change in the United States, which basically said to the pension fund trustees of private sector pension funds, you have to invest in, you should look at venture capital, and if you don't invest in it, you should explain why. The size of the average venture capital fund went from $2.5 million in 1977 to $30 million. $30 million, more than 10 times the size, just a couple of years later.
And Ronnie, I'm so sorry, but we're sort of slightly over time. And I think on that very positive, again, historic point of reference as to what one change can do to stimulate a movement, I'm going to thank you, because I want to thank you while we still have all our participants online, and say thank you so much for a great conversation. It's always such a pleasure. We'll do it in real life before too long, I'm sure. And to everybody that's joined, I've never seen quite so many rich questions and comments. Thank you very much. I'm sorry we only managed to scrape the surface. Thank you so much for that engagement and interest. Please do stay with us. You can follow us on Twitter and online, and we hope that you'll continue to be part of our growing community. Wishing you all happiness and health, and look after yourselves. Bye-bye.
Bye-bye. Thank you.